Good morning, everybody. Hope you had a wonderful weekend. I want to start with a little sales tip that sometimes we forget. So, do people like more choices or less choices? Do people like more choices or less choices when it comes to buying TVs, buying houses, buying anything? Steve's got it. Artie's got it. Yeah, this is what happens when you give people too many choices. They want less choices. So a behavioral science study analyzed, just to give you an example, and this is actually financial related, analyzed company-sponsored retirement plans for 800,000 workers. The number of funds offered affected the participation rates. When 2 funds were offered, 75% participated. When 59 funds were offered, only 60% participated. So there was a 2% reduction in participation for every 10 funds added. So that tells us what? We should all be offering more or less. So, and maybe some of you that love psychology like I do have seen this study, the JAM study. A grocery store conducted 2 tasting sessions. In one session, the shoppers were allowed to sample 24 flavors of jams, and in the other session, they were allowed to sample 6 flavors. So with the 24 choices, it attracted 60% of shoppers. 6 choices only attracted 40. So which seems better? Hey, more choices attract more people. Less choices attracted less people. But shoppers sampled an average of 2, and shoppers sampled an average of 2. So it didn't affect how many people were actually, how many flavors they wanted to sample. Only 3% when 24 were offered bought jam, 30% bought jam. And yeah, that's right, Mark. It simplifies this is a great example, right, Mark, of it simplified the decision-making process. Here, though, I don't even know what to buy. So here's the question for you. How many choices, and this is in the participation rate FIA presentation, how many choices do we offer in a FIA presentation? FIA presentation. How many choices? Tom says 1, 2, 1. Ah, Greg. Very good, Greg. Greg got it. We offer 3. We offer 3. We offer 3. We offer 3. We say there are 3 types of investments you can do, right? Safe investments. An example of that would be like CDs, savings accounts, etc. Then you have market investments, so things that can go up and down. And then we have the Warren Buffett option. So we gave him 3 choices, and it ends up, guys, all the psychology, guess how many choices you should give people? What is the best number of choices you can give people? Want to take a wild guess? Yeah, Ben's got it. 3. That's right. So guess what I use over and over and over? Look at all my presentations, and I've got 3s all over the place. Do you think that was an accident, or do you think I meant to do that? No, I meant to do that. I meant to leverage behavioral psychology in our favor. And then we say, hey, there's 3 things the market can do, which is market can go up, market can go down, and market can go sideways, right? Then we say, so if the market goes up, is a safe investment a place to be? No. And okay, if the market goes up, is a market investment a good place to be? Yeah. How about the Warren Buffett option? Is that a good place to be? An okay place to be? What is it, guys? Is it okay or not, guys? Warren Buffett option. Yeah, it's an okay place to be. Market goes down, is a safe investment an okay place to be? Of course it is. If the market goes down, is a market investment a good place to be? No. But if the market goes down, is the Warren Buffett, it's not a great place to be, but is it an okay place to be? Yes, it is. If the market goes sideways, is a safe investment okay? Yes. If the market goes sideways, is a market investment okay? So I answer this one. Is a market investment okay if the market goes sideways? See how many? Steve's got it. No, it's not. Why? Why is the market investment not an okay place to be when the market goes sideways? Ben's got it too. Ah, very good, Steve said. Steve said fees. That's right. Fees. So if you've got 2.5% fees, that means you have to go how much to get back to around even? You need to make 3% just to get back to around even. 3.5% just to get back around even. Is the Warren Buffett an okay place to be if the market goes sideways? Yes. So that means a safe investment, out of the three things that can happen to the market, a safe investment is right how many times? 2 out of 3 times. How many times is the market investment right? 1 out of 3 times. How many times is the Warren Buffett option right? 3 out of 3 times. But that's not the whole story, because if we go back to market investment, if the market goes up, where is the best place to be? Because we don't want to be in an okay place. We want to be in a what? We want to be in the best place. So do we or do we not want to be in the best place? We prefer to be in the best place, right? But so if the market goes up, where's the best place to be? Well, obviously the market is. Where's the second best place to be? Warren Buffett. Where's the third best place to be? Safe investment. If the market goes down, where's the best place to be? Safe investment. Where's the second best place to be? Warren Buffett. Where's the third best place to be? Market investment. If the market goes sideways, where's the best place to be? Safe investment. Where's the second place to be? Warren Buffett. Where's the third place to be? Market investment. So I'm a little confused here, Mr. and Mrs. Client. The Warren Buffett option is never the right place to be, but you keep telling me that that's what you like. So why would people want the Warren Buffett option when it's never the right place to be? Well, let's think about this. Can we ever choose to be at the right place at the right time? Can I ever choose to walk into that convenience store and buy the lottery ticket at the very time it's going to draw the winning ticket? Can I choose to be at the right place at the right time? I cannot. But can I avoid being in the wrong place at the wrong time? For example, if my son comes to me and calls me up and says, "Oh, Dad, I got jumped last night and they took my wallet and my phone," at first I'm going to say, "Are you all right? Are you okay? We can fix these things. I'm glad you're all right." I'm going to say all that. Then I'm going to say, "So what? Tell me what happened." He goes, "Well, it was 2 o'clock at night. And I was walking home from the bar by myself, and I was looking at my phone, and I didn't even see them jump me." What am I going to say? Nothing good ever happens what? After 2 a.m. What were you doing in the wrong side of town by yourself, looking at your phone at 2 a.m.? Dude, let's use a little what? Common sense here. Could he have avoided that whole thing? I mean, if he'd used some common sense and wasn't so tipsy, could he have avoided that? Yes or no? Yes. So you can't be in the right place at the right time, but we can avoid being in the wrong place at the wrong time. So why do all my clients like the Warren Buffett option? It's never the right place to be, but it's what? Never the wrong place to be, which makes it mistake what? Which makes it mistake what? Proof. So in our retirement, sure, we'd like to be in the right place at the right time. We'd like to invest at the very bottom of the market and get out at the very top of the market. Has anybody ever proven they can get out and get in at the same time by market timing? Has anybody ever proven that? Well, no. So mostly in retirement, what we want is what? Make sure we already have done a great job of saving, of investing, of putting together our nest egg, putting together our income. What we don't want to do is make a what? Well, a mistake. So what do all my clients choose? A safe investment, a market investment, or a Warren Buffett option? The Warren Buffett option. And why? Well, because you can't make a mistake. So, guys, guess how many billion, not millions, guess how many billions of dollars have been sold in the last 2 decades with this chart? Remember, this is in the middle of the FIA presentation, because the FIA presentation is designed to go through all the objections people have with FIAs. What are the objections people have with FIAs? Well, I won't make as much as the market. Well, is it safe? What about the fees? Is it liquid? Does the FIA have the client tell me, yes, it's better? Right here we saw, they're going to tell me it's better than a safe investment, better than a market investment. They're going to tell me that the fees are way more fair than with a market investment or a bank investment. They're going to tell me it's way more liquid. Guys, everybody answer with a yay or nay. Does the FIA presentation have a client explain to you that an FIA with a 10-year surrender charge is more liquid than a money management account? So how many other everybody's saying yes, yes. How many other FIA presentations exist in this industry that didn't copy me, because I've had this for 24 years, have a client tell you that an FIA is more liquid than a money management account? None. Should you be an expert? Here's the thing. We have a 94% closing ratio and half for 2 days over year after year after year. Markets up, markets down, interest rates up, down, war, no war, recession, great times. 94% closing ratio. And really we have 100% because usually the advisor just doesn't want the client for that other 6%. Why does this have a 94% closing ratio, this FIA? Because the client tells you over and over and over for an hour that this is the best place to be. It has the lowest, it has the most fair fees. It's the most liquid. It's better than safe. In fact, guess what the number one objection we get with this presentation? Michael's got it. What's the number one objection we get with this presentation? Michael got it. Nobody else knows? Andre has it. Oh, Bert said it's too good to be true. Guys, why would that never be an objection? That is too good to be true. Why would that never be an objection with our FIA presentation? Do I ever tell them this is a good place to put their money? Bert's got it. They're telling me. Very good. So Bert, you got your own answer there. They're telling me not once, but 100 times in an hour that this is the best place to put all their money. So they never say it's too good to be true. Because they explain to me how it works. They explain to me that it has a more fair fee structure. They explain to me that it's more liquid than a money management. They explain to me why it's better than a safe investment or market investment for retirement. They explain all these things to me. So when they explain to me, they don't have those objections. So I had a whole plethora of other people that had the right answer. The biggest objection we get with this is, why can't I put all of my money there? That's the only objection we ever get when somebody does the presentation right. And that's an easy objection to overcome. So guys, please, 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 if you're not using the FIA, if you did this in a workshop or you did this in a seminar, how many people would be clamoring to move money into FIAs with you? Think about that. The FIA presentation for 25 years, a quarter of a century, has a 94% closing ratio. If you have something with a 94% closing ratio, how good should you be at that presentation? Okay, so the main topic for today is taxes for families filing as a widow or widower. So six things to consider at a spouse's death. Should I file joint or single? Where you report your deceased final income depends on what day it's received. You're at risk of losing, and we're going to go into these in a little bit more detail. You're at risk of losing any capital losses. You can lock in your deceased spouse's estate exemption. You might need to take a postmortem IRA distribution, and there's a key decision on your home may need to be made. So let's talk about this. Filing status is a widow or widower can file jointly for year of death. So if they die in January 2022, they have all the way till the filing date of April 2023 to file as joint. And why would they want to file a joint? Because lower taxes, right? Lower taxes. Which form do you report your spouse's income? Well, any income received before the death is on your 1040. Any income received after death is reported on the 1041, U.S. income tax return for taxes and days. And because you can do that, it's going to be good for the widow or widower because most estates have very little income. So it's going to land them in a low tax bracket for that income after the death of the spouse. And the 1041 is not required to report income of less than $600, but you should recommend it to your clients that they actually do that form, even if they have less than $600, because it avoids the IRS flagging their particular tax return. Don't lose capital loss carryover. So you can deduct no more than $3,000 a year. So we know that if you don't have any carryover. The problem is that deceased losses could be lost if not taken in the year of death. If they don't take it that same year of death, they lose it. The best option is to find capital gains with which to farm the losses. And the losses in joint accounts can be complicated. Discuss with a taxpayer before the end of the year. If they after December 31st, it's done. So if they talk to their accountant in January, February, March, it's too late to do that. So they need to talk to an accountant before December 31st. So if you have a client that passes away, make sure your surviving client does what? If you have a client that passes away, you make sure the surviving client does what? Talks to an accountant before that's right, Steve, before the end of the year. That's right, Michael. Lock in your deceased unused estate tax exemption. So even if the estate is less than $12.92 million, which is what it is for this year, you should do that. Why? Because filing the Form 706, the estate tax return can lock in unused portions of lifetime estate tax exemption, doubling the size of the estate that can be passed on to the heirs when the second spouse dies. Why should they do this? Even if they don't have 12.92 in assets, why should they do this? Nick's got it. Yes, it can dramatically reduce estate taxes should the government ever lower estate tax threshold in the future. So good job, Nick. Postmortem IRA distribution. Don't wait until tax filing date to discuss RMDs. It could be too late to avoid penalties after December 31st. So make sure your deceased client's spouse is getting tax planning before the end of the year. And then key decision on appreciated home. If they sell the home for a profit, the joint exception is $500,000. A single is only $250,000. So they want to make sure they're going to have and guys, people who have lived in their houses for 20 years, could they have this kind of gain if they decide to sell their house? Yeah, easily. So if planning to sell appreciated home with gains above these amounts, you have 2 years after the death to sell and still claim exemption. And there's more good news. If the home is jointly owned, half of its value will be stepped up. So that's a good thing too. So guys, these are things. How many widows or widowers are aware of any of these things when their spouse dies? So if you want to keep that surviving spouse, would this not immediately, but within a couple of months of the spouse dying, does it make sense to sit down with them and go over these things with them to keep that spouse from moving their money from you? Yes. Make sense? Cool. Okay, and then today we're going to cover the VA fees on our continued exploration of the 21-point checklist. We're going to talk about the VA fees. Does everybody have their money in VAs? No. No, they do not. So guess what? Do we have a script for money managers? Yes, we have variable annuities, managed money, mutual funds, REITs, and do-it-yourselfers. So we have scripts for all of these. But we're going to talk about the variable annuity just to kind of walk through how we can get people to tell us that their advisor has screwed them. But the same techniques we use for variable annuities, let me see if I can go here. I'm going to get out here a second. So if I go to 21-point checklist, and I go to fees, see, money management, I have tutorial here, an hour, 2 minutes on how you, and money management crib notes right here, on how you get them to tell their advisor is screwing them with the money management fees. If I go back here, same thing with mutual funds. Have the scripts, the audio, the tutorial. Go back here, we have the same thing if they have REITs. Script, video, audio on how to get them to say their advisor is screwing them when it comes to REITs. So we have, and same thing with do-it-yourselfer. So we have those scripts. Today we're going to talk about or go through the variable annuity. Okay, so here we go. Bring up the training video. And we'll find VA fees. Straight or sugar-coated?
No, straight.
Straight. So now don't have to worry about fixing things after the fact. If you worry about fixing things after the fact, is that easier or harder?
Yeah.
Okay, so now, remember, the fees comes right after the beneficiaries. So we've done titling and we've done beneficiaries. So at this point, he didn't know, because there's 3 reasons somebody could do something wrong, right? Didn't know, and that's what? That's the titling. Didn't care, that's the beneficiaries. The next thing is he did it on purpose. He either did it because he didn't know, didn't care, he did it on purpose. And which of those is worse? Didn't know, didn't care, did it on purpose. Which is worse? Didn't know, didn't care, did it on purpose. What would you get angry at, most angry at? They're all bad. Which one would you get the most angry at? On purpose, that's right. So now with fees, we're jumping from didn't know, didn't care. Now we're going to on purpose. So before we tell somebody something bad, we have to get what? So let me ask you a question. Let's say we're in spring, right? So we're all taking care of our yards. So let's say I have a yard it's one of the worst yards in the neighborhood, and I've decided to make it better. Decided to make it better. And my neighbor comes over and says, geez, you know what? Let's say my neighbor has a really nice lawn. So I say, hey, neighbor, you got a really nice lawn. Look at the work I put into it. What do you think about it? And he goes, oh, I'm glad you asked, because the whole neighbor's talking about it. What kind of fertilizer are you using and how often are you doing it? Because you're doing it wrong. You got to aerate. Why aren't you aerating? And, these weeds, you got to get ahead of those weeds. You got to do this. And he goes on and on and on. What am I thinking? Sorry, I what? Sorry, I asked. Am I happy with him, or do I get irritated with him? He starts giving me a laundry list of how bad my lawn is. I'm going to be mad at him, irritated with him. But I asked him, and he's thinking, well, you asked me, so I'm going to what? I'm going to tell you. So instead, when I ask him, what he could do is say, well, do you like things sugar-coated, or do you like things straight? What does he just telegraph to me if he says, hey, neighbor, what do you think about my lawn? If he goes, well, do you like things sugar-coated, or do you like things straight? What does he just telegraphed me before he says anything? It's going to be good news or bad news? Bad news. And he's asking permission to what? Give me the bad news. Now I have the right to say what? If I've had a bad day at the office, I say, oh, you know what? Forget it. I know I got some work to do. Let me do some more work and I'll come back. I have permission to what? Say, I don't want to listen to you criticize me. Do I have permission to tell him I don't want him to criticize me when he says, do you like things sugar-coated or not? Yes, I have permission. He's given me that permission, so I could either say I've had a bad day, or I can gird my loins and say, okay, give me the bad news. If I know bad news is coming, can I accept it better than if it's out of the blue? Because when I ask him, I'm thinking I'm doing a good job here, right? So if he just starts criticizing me and what I think out of the blue, I'm going to get defensive. But if he gives me that warning, can I get defensive? I guess I could, but normally would I get defensive? If he's giving me a warning, he's going to give me some bad news. I'm going to be way less defensive. Does that make sense to you guys? So when we go into the fees, we're just about to tell them what? Their guy is what? Stealing from them. He's charging them more and giving them less. They could have paid a lot less and got a much better result. So guys, would you want to pay more to get a worse result, or pay less to get a better result? Obviously, we'd want to pay less to get a better result. So they're going to find out my guy is withholding information. He did not show me choices. He did not show me choices not because he made a mistake, not because he doesn't care, but because he did it on purpose, because by not giving me these choices, he's making more money. And to add salt into the wounds, maybe I could be okay with him making more money, but by doing that, he put me in something I'm making less or getting charged more than I would have otherwise. So it's a double whammy. He's making more, I'm taking it in the shorts where he could have made less, and I came out better. Does that make sense? So that's why, no matter whether you do VA, money management, mutual funds, or REITs, guess what we always start with? Because we just did titling, doesn't know, beneficiary doesn't care. Now we're just about to get to he's stealing from you. So we're going to say, well, do you like things sugar-coated or you like things straight? I'm going to let them gird their loins because they're about to get some really bad information. Make sense?
No, it's harder.
Yeah, it's harder. So we also learned that you may be paying some unnecessary account fees. Now, are you the kind of people that like things straight or sugar-coated?
No, straight.
Straight. So now this fee, actually you have these unnecessary fees are coming from 3 primary places, okay? We're going to talk about all 3 separately. Do you want to know what those places are?
Oh, yeah.
Okay, super. So before we do that, I forgot to ask you, I did find that you have a $5,000 paid up life insurance policy. So if it's paid up, that means you're paying how much every year?
Nothing.
Nothing. So makes sense to keep it?
Oh, yeah.
Darn tootin', right? And then they can use that for what?
Burial expenses, stuff like that.
Just, yeah, exactly. So it makes sense to keep that. But do you want to buy some more insurance now?
No.
I mean, is your home paid off?
Yes.
So do you need it for that?
Nope.
Kids still at home and
No.
and taking you're still giving them an allowance every?
No.
Okay,
no.
their college is paid.
No.
Okay, so do you want to leave a rich spouse?
No, not really.
So is there any reason for you to have life insurance at this point?
No.
More, the $5,000 perfect anymore.
No.
And if you did, how much would that cost?
Oh, I'm sure it would be expensive.
It would be expensive, right? So can you find other uses for money at this point rather than buying life? Yeah.
So far, how many times has he told me he does not want life insurance? Yeah, 5 times. So can he come back later and say, I want life insurance? No. That's why I have him tell me 5 times he doesn't want life insurance, because when he finds out he has life insurance, he can't come back and say, oh, well, I guess that's okay. No, he's already told me in no uncertain terms, no more life insurance.
Yeah.
So it's super. Now, if you were going to buy, well, first of all, the first account I want to talk about is your variable annuity. And when we looked at that, I mean, it looks like it's doing okay. I mean, in the last 10 years, how's it done?
It's done pretty well.
It's done very well, right?
Yeah.
Am I attacking his investment? We're saying, hey, no, your investment is what? Doing just fine. See, again, we said the template for these is we always start out with they're doing what? Bad or doing okay? Whether it's a power of attorney. Oh, great, you got a power of attorney. Oh, great, you have a joint ownership. Oh, it's great, you have diversification. Oh, great. I mean, every script starts out with you're doing okay. So we're coming across balance because, hey, how did variable annuities do in the last decade? They did great. This is not about whether their investment is good or bad. It's about what? This is not about whether their investment is good or bad. It's about what? Well, here's a good question for you. Is this script about variable annuities are bad? Is this script that variable annuities are bad? Andre's got it. Michael's got it. Bert's got it. Dale's got it. That's right. It's not. It's not about whether these are good or bad. It's about the information their advisor withheld and why he withheld it. So good job, you guys. You're awesome.
And they have 34 accounts in there. Does that seem like a pretty good choice of 34 accounts?
Oh, yeah, that's a lot.
It's covering. I mean, it's got a lot of good managed in there. It's got a lot of good choices in there. And have you ever had to move the accounts around at all inside there?
I think we've done it in the past, not often.
Okay, but do you remember, did they charge you or not charge you?
I don't know. They didn't charge.
They don't?
No.
So is that a good thing?
Oh, yeah.
And are you hit with taxes every time you make a move?
No.
No. So all in all, performed well, easy to use, good thing or bad thing?
That's a good thing in my
It
opinion.
is a good thing, right?
So I've just said what? I validated everything that their advisor told them about VAs. Hey, they're in the market, so they perform well. You got lots of choices. There's no cost to move things around. There's no taxes to move things around. VAs are pretty good. Did I just resell the VA exactly how they were sold it? Summarize all the selling points that guy gave them. Yeah. So am I saying that he told them a lie? No. It's not about him telling a lie. It's about him withholding other information. That's what we're going to get into.
Right? So now if I wanted to buy a car and I wanted the best car possible, would I go to the Ford website or would I go to the Consumer Reports or Kelley Blue Book, something like that?
You'd go to Consumer Reports or Kelley Blue Book.
Right. And because if I went to the Ford and said, what's the best car, what's Ford going to say?
Oh, Ford.
Ford. Why do I go to Consumer Reports then?
Because they're just going to give you more accurate information.
More
They're
accurate.
just going to compare better.
Yeah.
So I'm overcoming an objection that I used to get all the time. I used to show them that Morningstar was pointing all these things out, that they're getting screwed, and they would say, what? Well, why should I believe Morningstar? They probably got an axe to grind. So I'm going to have them tell me up front that Morningstar is valid, so later they can't tell me what? Morningstar is not valid. So you see some of these things in the scripture, like, why are they so long? They're so long, just like we talked about last week. So to overcome objections before they come up. That's the advantage of using scripts that have been used 100,000 times in the last 20 years. We know what the objections are, and we overcome them before they come up.
So it's kind of, is it better to go to a first party like Ford or a third party resource like Consumer Reports?
Better to go to a third party.
Do they care what kind of car you buy?
No,
No.
they don't care.
They're just giving you what?
Just the information.
Information. If we found out they were in bed with Ford and were pushing people towards Ford, what would happen to their whole business?
Oh, they'd go under.
Yeah. So if we're truly looking for unbiased information, we go to
Third party.
Third party. And for investment third party, we use Morningstar.
Okay.
So have you ever heard of Morningstar?
Yeah, I've heard of them.
Okay, good. So and Morningstar gives you more information than you would ever need or want. Let me give you an example on your variable annuity.
Okay.
So does this look like a lot of information?
Yeah, that looks like a lot. Yeah.
So the first thing we want to talk about is some of the expenses of your account, these fees.
Okay.
This M&E, mortality and expense risk, is 1.5% a year.
Right.
So have you ever heard of mortality and expense?
No, not really.
Okay. Mortality and expense is, if I can find, perfect, we can do it right there. So mortality and expenses, do you remember when you were first sold this, they said that if your accounts ever go down and it causes you a heart attack and you die, guess what they're going to do for your loved ones?
Make them whole.
Make them whole. That's the mortality and expense.
Okay,
so right now you have 3,011, and see if I can get this right here to catch up with you.
And just a point I haven't brought up over the last few weeks, those of you that have received my thank you cards, do I have good handwriting or crappy handwriting? Many people tell me that my writing upside down is better than my writing upside right. And what's more important if you want to make money, writing upside down or writing upside right? Do you want to make money? Writing upside down. Why? What does writing upside down show them about me? Of all the things I did for people, guess what the comment I got most often from people? Not, boy, you're a great money manager. Oh, you're a great explainer. Oh, no, it was always like, wow, you can write upside down. It tells them that I'm a consummate professional. Tells them I have done this how often, if I can do this upside down. Tells them I've done it over and over and over. If you're getting if you're having surgery, do you want a surgeon who looks really deft and coordinated with the utensil, or do you want somebody who's bumbling with it and drops it on the floor before surgery? Or even, how about your dentist? Do you want your dentist to drop, or you're getting your hair cut? If you're the person cutting your hair, something as little as your haircut, which can go back in a month, if they drop the scissors 2 or 3 times, what are you thinking? Oh my God, is this person drunk? Do they know what to do? So that's what writing upside down does for you.
Oh, I guess not. To catch up this way. So you have 311,874. Does that sound about right for what you have in that account?
Yep.
Okay. So do me a favor.
Okay.
And multiply 311.
I have him multiply it on the calculator, because if he taps it on the calculator, then it is what? Legerdemain, sleight of hand, or it's truth? It's fact, that's right.
Oops.
So we'll clear up here. 311 874, and multiply that times 1.5%. Oh, you hit 0 there. Yeah, that's okay. So let's clear it. 311,874 times 1.5, and we'll hit the percent button. What does that end up being?
$4,078.
$4,700.
It's $4,700 because who says so? How important is it for him to say that versus me? Is that a small thing or a big thing? It's a huge thing.
4,078.
Okay, 4078?
Yep.
Okay.
And 11 cents.
Okay. 4,078. Okay. So that's the mortality and expense fees.
Okay.
And we said, again, that's for if your account goes down, they're going to make your loved ones what?
They'll make them whole.
Yeah. So could this account go down by 30,000?
It could.
Well, in the past, I mean, do we have market corrections?
Yep.
Which is why you maybe got this mortality and expense charge, right?
Mm-hmm.
So that if it goes down $30,000, and they said at your death they're going to do what for your loved ones?
They're going to make it whole.
Yeah. So when a life insurance company, which is who your variable annuity is with, when you die, they give your loved ones a death benefit. What do we call that?
Well, that's life insurance.
That's like.
So did I say that was life insurance, or did he say it was life insurance? He said it was life insurance. I don't want him to argue with it, so he must say it.
Life insurance. And you said you did or did not want more life insurance?
Well, we didn't.
But what do you have?
We have life insurance.
Yes. And if you're going to buy life insurance, we said that life insurance would be cheap or expensive?
It would be expensive.
Yeah, there's only one kind of life insurance that's more expensive than life insurance at your age. Guess what kind that is?
This life insurance?
Well, $4,000 covering $30,000 of life insurance. Does that seem expensive or not expensive?
No, that's really expensive.
You could easily get $150,000 for that. So if you're only getting $30,000, is that expensive or not expensive?
That's very expensive.
It's very expensive. And if you want life insurance, you want the cheaper, expensive kind.
Oh, we want the cheap kind.
Yeah. Now, the other thing is with this is that does the IRS ever do us any favors?
No, not that I can think of.
No. But can I show you at least one time they treat us fairly?
Okay.
They think that if you're a good breadwinner or a good family member and you buy life insurance to protect your loved ones if something happens to you, when they pay out that death benefit, again, they want to be fair. So if somebody's taken the action to do that, to protect their family, guess what they say about whether it should be taxed or not taxed, the death benefit?
I think it's not taxed.
They want to be fair, right?
Right.
So 99% of life insurance is not taxed, which is the right thing to do or the wrong thing to do?
That's the right thing to do.
Now, if we talk about that 1% of life insurance is taxed, guess what kind that is?
This kind?
This kind. So if you bought life insurance, which again you said you did or didn't want,
well, don't want.
Would you want the taxable kind or the 99% that's not taxable?
I want the 99% that's non-taxable.
Instead, you have the cheap or expensive?
The expensive.
Taxable or non-taxable?
Taxable.
But to be honest, did you get into this to lose money?
No, we were hoping to make money.
Yeah. So if we have 311,874 and you have lost no money, how much are you down?
We're not down anything if we didn't lose anything.
Zero. So how much life insurance is there?
None.
None. But what's 311,874 multiplied by 1.5%?
That's the 4,078.
So now you're paying how much?
Well, we're paying $4,000 for zero.
Is that expensive?
Oh yeah, that's ridiculous.
I guess you're not paying tax on it, but
right.
So, but did you get into it lose money, not make money, or make money?
Make money.
Make money. So what would you think is a good return you could make on that in a year?
I would hope for, in a good year, at least 10%.
10%. So can you do me a favor?
Mm-hmm.
Clear that again with the clear button.
Okay.
And then let's type in 311,874. And we're going to multiply that times 1.11, which is 10%.
346,000.
So So 346,
0808.
perfect. We don't need the cents now.
Okay.
Now, can you multiply that times 1.5%?
Looks like $5,190.
So now, if you made 346, it's gone up. Is there any life insurance involved there?
Not if it went up, no.
No, because 346 minus 346 is what?
0.
But now you're paying how much for 0?
5,000.
So is it helping you when you grow?
No, it's actually making it worse.
So I guess it is what it is. You've done okay, haven't you, over the last 10 years?
Yeah, the account's done well the last 10 years.
Right. So I guess I'm wondering though, were you shown those managers you have are good or not good? They've done what?
I think they're good.
They're good. Were you shown that you could have invested in those exact same money managers? Exact same funds without the life insurance?
No. We weren't shown that.
Because if you had been, would you have bought it with or without the life insurance?
Oh, I would have bought it without.
Because you've had it for how many years?
Oh, over 20.
You've had that over 20 years?
Yeah,
Well, how much money have you spent over the last 20 years?
like $80,000. Yeah, that's a lot.
So, could you have done something else with that $80,000?
Yeah, a lot. Yeah, we could have done a lot with that.
Heck, even if you only had it for 5 years, how much would you have spent?
20,000.
Could you have done something with that?
Oh yeah.
So if given a choice between the same managers with or without the insurance, you would have done what?
Oh, I would have done it without.
So where's all this money going?
Okay, so he's decided this sucks, right? He'd rather have had something different. Am I done? No. What does he have to do now? What does he have to do now? He has to tell me what? Because if all you do is happen to say the VA sucks, can they go back to their guy and say, this VA sucks, get me something different, and will he do that for them? Absolutely. He makes another commission. They have to say what? Their advisor, well, you're close, Nick. It's not the advisor's fault because that didn't care. I have to prove that he what? Bert's got it. Howard's got it. Yeah. He did this on purpose. That's motive, right, Dale?
Company's pocket.
Yeah. So how do you think companies like this life insurance company get investment salespeople to sell this insurance with the money managers instead of, because these money managers.
Now remember, am I going to say a bad word about their guy at all? Utter a bad syllable about their guy? No. Who has to point the finger? I'm going to facilitate it, but who has to point the finger? He does.
Mm-hmm.
Most of them are no load. What does no load mean to you? No sales charge.
No sales charges, yeah.
So most of these are no sales charges. So how do you think this life insurance company gets people to buy it with the insurance versus buying it without any fees whatsoever? How do you think they get to find the investment salesman to sell those?
I'm sure they pay him more.
So why do you think, is this something you were aware of?
No, I had no idea.
And if you had, which one would you buy? With insurance, without insurance?
Oh, without insurance.
And why did this happen to you?
Well, they wanted to make more money.
Yeah. To benefit you because?
Oh, no. So to line their own pockets.
Right. So something you should know or not know?
Oh, no, I'm glad I know.
Okay. So that 4,078, remember there's 3 places that this fee is coming from?
Yeah.
That's one of the places. 4,078 is coming from that. We're going to talk about these other ones as well, okay? So the next thing we want to talk.
So how many people want to get rid of their VA and leave their advisor after this script, do you think? Yeah, John says 100%. That is that's right, Michael. All of them. So, guys, let me get out of here a second. So, if 94% of people want to move their VA, want to buy an FIA with this presentation, and 100% of people want to move their VA, guys, have we given you scripts? Is there any reason for you not to be making as much money as you want? If you want to make $300,000, can these scripts make you $300,000 a year? If you want to make 500, can these scripts make you $500,000 a year? If you want to make $1 million a year or even $2 million a year, can these 2 scripts here make you $1 million or $2 million a year if you know them, backwards and forwards? Give me Y's or N's. Got a handful of Y's. Come on, guys. Y's or N's? Yes or no? Okay, now everybody's giving me Y's. So what is holding you back from making all the money you want to make? See, these kind of scripts, remember, this is 1 out of the 21 scripts. It's these kind of scripts, and the FIA presentation is not even the sale presentation. So these scripts can make you as much money as you want. Should you be afraid to market if you know these scripts backwards and forwards? So please, please, please learn these scripts. So we're at 10 minutes to the hour. I'm going to just go ahead and start at the top of the hour. But what we're going to talk about in this script review, because we're just in the variable annuities, I'm going to talk about the managed money fee script on the script review call. So at the top of the hour, we're going to do fees again for the script workshop, but we're going to talk about money management fees, because where's most of the money you're finding nowadays, guys? In VAs, managed money, mutual funds, or REITs? Where's most of the money you're finding? There's still lots of VAs out there. Remember, there's $1 trillion in VAs out there. There's a couple $1 trillion in mutual funds out there. There's billions and billions in REITs out there, but where is most of the money that's in here? So we're going to walk you through how the script gets them to decide their advisor is taking advantage of them. Now, again, guys, am I saying in these scripts that a variable annuity is bad, money management is bad, mutual funds are bad, REITs are bad, that you're bad for being a do-it-yourselfer? Do I say any of those things? No. It's that the guy left out valuable information that you would have made different decisions if they had. And the reason he left that information out was so that he could make more money, which unfortunately put you in a worse position. Does that make sense? Coolio. So please learn the FIA presentation. Please learn the 21-point checklist. And that's going to, again, unless you're making as much money as you want, but if you want to make more money, these scripts have been tested tens of thousands of times. Please learn them, okay? Awesome possum. We'll talk to you all at the top of the hour. Thanks for being on the call. Those of you who will be in the call here in 10 minutes, look forward to talking to you. And then those of you that will not, have a great week, and we'll talk to you next Monday. Thanks, everybody. Bye-bye.